3, 2, 1, and 0, and liftoff.
Hey everyone, this is Greg Lafferty, the Rocket Guy, and you're listening to the Rocket Guy Real Estate Investment Network. Come check us out at therocketguy.com, where we have all kinds of extra resources and things to help you explore whether investing in real estate is right for you. You know, it's right for me. It might not be right for you, but come check us out. We're all about education here at the Rocket Guy. And so we want you to be able to explore that a little bit deeper. And so today, let's talk about we're going to kind of take a stab at an economic outlook for 2022. Wow, it's 2021 almost over. It is. And so, oh my goodness, 2020 was tough. 2021 is tough. So please, nobody make a prediction about 2022 and what your life is going to be like, because that would just be wrong. But you know, outlooks are an educated guess. And we're going to use a little bit of education here to try to make a stab at it. I was once in an economic briefing by a real estate economist, and he said, well, you could have Ben Bernanke up here and you paid a bunch of money, but you know, he'd be just as equally potentially as wrong as I am. So and I'm kind of saying, I'm free. So you have a choice of, you know, listening to somebody very, very expensive and he only getting it half right, or listening to me and I might get it half right, or maybe less. So, but we're going to take a little stab at it and kind of talk about some of the forces and other things that are involved in the economy, and especially around real estate, because that's what we do here at the Rocket Guy. We invest in real estate. So let's kind of take a little stab at what's going on and what to look ahead for in 2022. So really, you know, in the directions of the market has three choices, right? It could go up, down, or sideways, okay, kind of neutral. That's really all it can do. So we could have appreciation, we could have depreciation, or it could just kind of stay flat. And the trends one way or the other, right? It could be a very high appreciation market, or it could be just flat as a pancake, or somewhere in between. So, you know, typically real estate kind of follows a general upward trend. There used to be a saying before the Great Recession, you can't lose money in real estate. Well, that's not true. Okay, that's not true. You can't lose money in real estate. So let's put that out there. But generally, real estate has a nice, comfortable, you know, somewhere around 3 to 5% or so appreciation, depending on your market. You get out in the Bay Area in California, you know, it's all kinds of cycles, up and down, big swings either way. But generally across the country, it just kind of generally climbs and outpaces inflation a little bit, and it's a nice casual thing. But you know, in real estate, we have all kinds of forces out there that drive buyer behavior and supply and demand and other things, and all different layers involved in that. And some forces that drive the real estate market are very macro or big picture forces, and some are very micro, very small picture forces. And so macro might be all over the country, and micro might be just in your hometown. And so something happened just locally, and you kind of have to look at both to really size up where you are. So there might be something we talk about here this morning that you see that's will affect the entire country, and certain things you have to take a step back. And I can only speak to what's happening here in my local market. I can't really talk to every market in the country. So you might have to kind of weigh some of those things. And most of it is really supply and demand basics, okay? Going back to Econ 101 in school, where it was like 400 people in this one class, and some professor had to get up and ramble for about an hour or so. But it's a lot of supply and demand. And so, for example, you know, like micro impact might be something like migration patterns, or the job market, job availability in your local market. Are people moving in and coming in to take advantage of new job opportunities that have come in over the last 12 or 24 months? Or people leaving? So back in the recession in 2009, 10, it was like last man out of Detroit, cut out the lights. Okay, everybody was leaving. But here right now in the greater Charlotte area, a lot of people are moving in from out of state. So those are kind of micro levels in your local market. A macro supply and demand factor, or something driving the economy of the macro market, might be lending rates, right? Interest rates and things like that, and the availability, supply and demand of the money. okay? And that's kind of a little bit more nationwide. So let's take a look at some of these forces that can kind of move the market up, down, or sideways, right? And see kind of where we, what our crystal ball says, where we're going. So let's talk about the things that drive it up, moving on up, like the Jeffersons used to say on TV. That kind of dates me. Sorry about that. So, I talked about that real estate has normally an upward trend, and that's generally a nice, consistent 5-ish% kind of upward trend. That's very healthy. The economy's expanding, everything's good. New household creations, things like that are happening and kind of driving that price up. There's factors that could drive higher trends, right? What about if you're in a strong, like in the greater Charlotte area, how about if you have a very strong attraction to new people moving in? So we're just a couple hours from the mountains, a few hours from the beach, good economy here in the greater Charlotte area. So lots of people tend to want to live here. All the people that went from New York down to Florida and then decided that was too hot, so they're coming back and splitting the difference here in the Carolinas. We call them halfbacks. So they came on down to Florida and then moved halfway back. So a lot of people moving in our area, and that tends to create a buy pressure, a demand pressure on the market, and we don't have enough supply to help with that. So it tends to drive prices up. The other thing that that helps with that as well is that the pricing up in places like the Northeast, New York, New Jersey, those kind of things, their house prices are so much higher than ours have been traditionally. And so when they sell their houses, they typically have a lot more cash in their pocket to be able to reinvest. And they're like, wow, you mean I can get a 4-bedroom for the price of a 2-bedroom up in New Jersey? Yes. And so they get excited, and everybody kind of clamors around and tries to find the bigger house, right? And so, and they have all this cash, and they're coming in and able to take what they had a mortgage on up in New Jersey and come down and pay all cash for a new home down here in the Carolinas. So there's a lot of extra cash kind of flowing into the market. The other thing that drives cash into our market have been the government subsidies, right? So lots of COVID relief and other things like that, government spending to stimulate the economy. That's kind of an artificial influx of cash that doesn't normally happen, and it tends to drive extra spending, right? Typically, Americans spend about 1.1 or 1.2 times the amount they earn. So if they're constantly spending more, of course, as suddenly they have extra cash in their pockets, they just can't hold on to it. It just like there's holes in their pocket. It just falls right out. So what tends to happen is they spend more, and as they spend more, the price of things tend to go up because there's a higher demand, because there's more money in the economy to use to buy up goods and services. So it tends to cause the prices to rise. The other thing that impacts the cost of housing, though, is also because we are having an inflationary period right now, not hyperinflation, don't get crazy or anything like that, but the prices of things are going up. And as a builder, we see this, right? I get calls all the time. Price of lumber's going up, price of tubs going up, everything's kind of generally rising up. Well, then that drives the higher replacement cost of the houses. So you have people coming into a market, very micro. I have people coming into the Charlotte market here in our local area, and they can't find a resale home to buy. There's not enough supply out there, and of course the builders are trying to build as fast as we can, but dang, we can't get the parts. We have supply chain issues and other things like that, and then that causes all the pricing of all the materials to go up, which then causes the house price to go up. So, and if a new home goes up, of course, then what happens is the resale value of existing homes also tends to rise, because a buyer has a choice, right? Either I could go buy 1,300 square feet over here, brand new, and it costs $280,000, or I could buy this other 1,300 square foot home from the 1960s that still looks good. It's a good quality home, and so I might not pay as much, but if the price of the new home continues to rise, the resale price looks more attractive as well. So all those are factors. And of course I mentioned that we have supply issues for labor and materials to get the new products to market, to provide some supply for this increased demand. And those are all pressures that tend to make the price of homes go up. So if you're sitting in a house right now and you're a homeowner, you're watching all your neighbors' homes go up in value here in the greater Charlotte area. There might be places in New York and other places where people are moving from, and it might be a downward trend, but those are in our micro market, that's what tends to go up. The other thing is that if interest rates continue to stay low, then people could continue to pay more for a home because they can afford more if the majority of their payment is not going to pay higher interest. So that just kind of tends to do that. Also, as lenders are liquid, right? They would love to lend money, and they're not restricting. In 2009, 10, they started to kind of pull. It looked like T-Rex, right? Their arms got shorter. Like, I like to borrow some money. Whoa, we're not lending on real estate right now. So access to capital, access to lending is something else that tends to, if it's free access, open access to money, tends to drive the value of the homes up. So all those are indicators. What about on the downside? Okay, we're sliding downhill. What should we be watching that could have a downward pressure on this? So one thing I've noticed is what about if buyers get frustrated and they just kind of come out of the buying market altogether? So what if all that demand tends to taper? So what if you're trying to service all this demand and finally the supply chain thing starts kind of opening back up and new homes are coming in the market, maybe as COVID starts to wane and people feel more comfortable putting their homes on the market, we tend to get more supply, and then the buyers sit there and go, man, this has been frustrating. I've been looking for a new house for a year and I've made 30 offers and I just can't do it. You know what? I'm just going to stay in mama's basement. Okay. What if they do that? So then you have kind of that waning demand and more supply. So that would tend to push the prices of the homes down. One thing that we've noticed here in the greater Charlotte market is that there's a ton of Wall Street money coming in, and a lot of the houses that we build, investors put offers on the houses right as it goes on the market. And I'm not sure exactly who these folks are, the hedge funds or insurance products or what they're doing. And I'm not sure even what their game is, okay, because I've always learned that real estate is a long-term play, okay? And typically Wall Street is not into long-term plays, right? But what they're going to have a hard time doing is liquidating their position, okay? Because Wall Street is used to being able to make a phone call and dumping massive positions of stocks and bonds and other things and moving money around like crazy. And so I'm sure they're smart. They've got MBAs and all that kind of stuff, and they figured this out. But if someone were to call up from Wall Street and say, hey, I know we own 3,000 houses in the Charlotte market. We need to sell them all. Okay. That would be dangerous for everybody. Okay. So it would be hard for them because if they just drop all their product out on the market, obviously there would be a much higher supply. The demand would be kind of even, so the price would start to fall. They would get less and less and less for each home that they try to put on the market. It would also drive everybody else's prices because maybe even as a builder, I'm competing to try to put a product on the market against someone who's dropping them all, and they have to lower their price. I'll have to chase them down to the bottom, right? I'll have to lower my price as well to see which one of us attract the buyers that are still there. So that could be a real problem. So I'm not sure exactly. They might end up, somehow putting these real products, these real assets into looking more like paper, and they might sell the paper out there in some kind of secondary market, and that screwed us all up in the crash when they did that with mortgages and mortgage-backed securities and other things like that. It's a whole nother topic. Okay, so that could be a problem. But if they come out and put a bunch of for sale signs out on the real estate and they try to sell 10,000 houses, we're just not absorbing that many right now. So that could be a problem. What other things could affect us on a downside? Well, what about if inflation starts to really pick up and the Fed has to step in or and start to do stuff to drive, right, to slow down inflation and control the economy? And things will happen to change the interest rates, okay? And so I'm not really concerned about the Fed rate as much as I am the 10-year Treasury bill, but that kind of drives a 30-year loan. Another topic for another day, but But basically, if the home lending interest rates start to rise, then a lot of times people, when they're buying homes, they're right there at the max. They don't look, well, you can buy anything upwards of 400,000. Well, they could buy something at 3, but they typically think about, oh, I could buy at 4. Well, so they're right there at the edge. So if their interest rate rises, no longer they qualified for 4, they're qualified for 350. So now they're going to start looking lower. And so, and they've already got their eyes set on what a $400,000 house looks like. So when they're trying to look at 350 or 3, they're going to, the market's going to have to chase down to the bottom to find those buyers. And so, because, the wages won't change. And so the average buyer that makes the average wage, now they can afford less than what they used to be able to. So you'll have to kind of find a product or build a product that'll be a little bit more affordable to them to drive that. So if the interest rates drive up, the prices will have to go down. The other thing that could affect it is high unemployment. Right now, there's a labor shortage. There's jobs all over the place. It's, the great, what do they call it? The great resignation. Okay, everybody's moving around like it's musical chairs. Okay. But if something were to impact the economy such that the unemployment started to rise again, then, of course, here again, they can't afford to buy. Maybe they have to rent. Maybe they have to go into the mama's basement again. And so prices of homes will have to drop a little bit to try to find where the buyers are. And that could be a challenge for pricing. The other thing that could happen is that the market opens up, right, and COVID kind of wanes, and everybody says, well, now is a great time to put my house on the market. I kind of didn't want to do it before. I didn't want people in my house and bringing the COVID into my home, but now I'm good. They can come and it's a good time to sell. If there's a flood of homes on the market in your area, that could kind of temper the pricing, maybe even cause it to drop. So, or if something happens and a major plant closes in your area and 2,000 people move out. Okay, all these things can kind of drive a downside in the real estate market. There's others, but you're trying to hit the high points. So what about sideways? What about if it just kind of goes about neutral? What if it kind of cools a little bit, doesn't go up, doesn't go down, just kind of hovers about where it is? So let's talk about that a little bit. So what if all these migration patterns kind of slow to normal levels? Because that's really what sideways is. It's kind of like, let's get back to more normalcy. Okay, of what's generally happened. So what if all this shuffling and these musical chairs and everybody's trying to decide what new career they want to do and where that's best done and where do I want to live and spend the rest of my life? What if all that kind of tapers and settles down to kind of more of a normal migration pattern, right? Then most markets would see kind of normal, either flat or slightly appreciating or slightly declining home values, right? But more sideways. What if all this government stimulus, et cetera, all kind of dries up, which it is, right? It's kind of driving up and then stops this artificial infusion of cash. So it's climbing like gangbusters. All this money's coming in the economy. Everybody's moving, everybody's buying and moving and shaking, and all of a sudden it just kind of just flattens out a little bit, okay? Could be a real thing, right? The government is kind of slowing. I think they've kind of used up the COVID excuse. They've ridden that horse about as far as possible. So that's kind of not going to happen anymore, right? They have infrastructure bills and other things like that. They're going to try to push cash into the economy, but in general, they've kind of ridden the COVID horse about as far as it's going to go. But what about if supply chain issues kind of settle down, right? Over time, hey, look, these factories are going to kind of get settled in and figure things out and catch back up. And so if the supply chain issues settle out, pricing for cost of materials and labor will kind of settle down to more of like normal levels. Doesn't have to go down to original levels. It just kind of has to settle down into something stable, right? That's all I'm saying is these things could just stabilize. That's where you start to see things flatten out. So it doesn't have to go, the cost of lumber doesn't have to go back to pre-COVID levels to get a flat, return. It's just a matter of it just has to get to something stable. And everybody can go, okay, well, this is the price of a 2x4 now. It doesn't go up from $1.25 to $4 overnight. Okay, it just kind of stabilizes. Might stable at $3.50. It's fine, right? What if the resale listings return to normal levels? People say, come on into my house. All that stuff can cause the real estate market just to flatten. Okay, and that's okay. Flat is okay. Flat is okay, because if it returns to flat, then everybody can kind of settle in. The music doesn't stop. Nobody loses money. Okay, it's just stable. Then buyers have a little bit more time to make better decisions. Things can happen a little bit better. It gets into more of a healthy mode, and then it can start to climb on its normal pace again. And nothing wrong with slow, steady growth. Okay, this takes it from a poker game, okay, high risk, high stakes poker, to something more like watching a treasury bond. Okay, so a little bit more consistent returns, a little bit better decisions, and a long-term play. So nothing wrong with that. So let's talk about what I think's most likely. Okay, I'm no expert. I'm just an outside watcher, okay, observer in all this. I don't have any control of the government and what things happen in laws and legislations, or the Fed and interest rates and all that kind of stuff. But I just kind of sit there and go, okay, well, let's see what's happening, and let's pay attention, and let's watching, because this is what I do. So I have to pay attention all the time, and kind of evaluate and twist and turn my business, and kind of play in the game a little bit. So I think that generally, the COVID stimulus from the government will continue to fade away. I think that, the infrastructure bill may or may not get through and figure things out. And, how much of that money is really going to go to entities and organizations that are going to push into the economy versus, it's just, some of the bigger contractors just get more money, but small business and other things that really drive the economy don't. And that'll kind of tell, kind of drive the economy. So we'll see. I think that over time, the supply chain issues will just kind of work themselves out. I think factories will adjust. They'll come up with new ideas. We are the country of imagination and the country of ingenuity. Okay. So we'll figure out the supply chain thing. I think that the materials and all will kind of stabilize. Either we'll learn to bring manufacturing back here to the United States, so we don't have to worry about importing and all that, or some of those forces out there will just kind of settle in to like a normal level, and we'll kind of figure out better how to handle them with this new demand and other things. So I think the factories will kind of figure things out over time. They kind of got depleted. They had to shut down, all that kind of stuff, and they're still kind of catching up. So it's just tough. I think the migration patterns will eventually settle in too. I think that the millennials will continue to create new homes at a greater pace than we've seen since the baby boomers. And so that'll be interesting. So that'll be more of the market driver than migration, which kind of disrupts everything. If everybody says, "Oh, time to move from New York, let's all go to the Carolinas," okay, that's a little different than just kind of traditional. Well, we have so many people coming and creating new homes and starting families and that kind of stuff. So a little less chaotic. It's a little more stable. So that kind of thing will settle down. But here's a couple wild cards that I'm kind of watching, because we have no idea who's going to just step up to the microphone tomorrow and make some kind of proclamation and change things, how things are going. So one is the inflation, right? What's that pace going to look like? Is it going to be higher than normal? Is it going to be long term versus short term? And that's going to be an interesting driver. Because that will drive the price of goods and services that affect home prices. It just will, right? So if you're having to pay a laborer $20 an hour just to get him to show up to work instead of $12 an hour, okay, that's gonna drive the price of homes. Okay, it just is. If lumber goes up from $460 a board foot to $1,600 a board foot, that's just going to drive prices of homes. And so as new construction rises, the resale prices will rise to float as well. So the overall national inflation levels are going to be important to watch. The other things that are going to be important to watch, one additional thing is interest rates, right? So The Fed will likely, depending on inflation, will likely step in and make some changes. Bond rates, other things will adjust. So the overall lending interest rates could rise or fall, and that could drive some of the market factors. Interest rates have been low. They've been on a 40-year low for like 10 years, okay? So they've been low for a while. I started when they were 10, 11, 12%, okay? They were double-digit interest rates, and you can only get a 15-year loan, okay, on commercial property and all that. So now they're in the low single digits, and you can get a 20 or a 30-year loan, and so it's just a different game altogether. But interest rates are something to continue to watch because as interest rates change, the value of the real estate products will change as well. And the other wild card that I'm really curious about is how is Wall Street going to deal with their inventory, right? And I'm talking about Open Door and Zillow and all these kind of things, right? And then just other investor funds and that. How are they going to deal with this inventory? Are they going to manage this for the long term? They're going to manage it for 10, 20 years? Or are they thinking that this is some kind of short-term player? They're going to commoditize it and sell it off in chunks? Or are they going to sit there and go, okay, just put them all on the market and I got to liquidate my position. This isn't working like I thought it would, okay? Because if they're betting on a very strong appreciation market and they don't achieve those returns they predicted, then they're going to try to pull their cash out and try to find other ways to get returns on their money. So that's going to be very, very interesting. That's something I'm kind of watching and trying to sniff around on and try to figure out what this game is. So if you know what the game is, I'd really like to know. That would be very fascinating. So those are some of the wild cards that I'm kind of paying attention to. But I guess overall, what I'm looking to happen in 2022, and I'm kind of hoping it will happen, is things will just kind of even out a little bit. I don't even need it to be flat. I would just like it to be a little bit more stable. Okay, because with stability comes predictability and planning, and I am a planner, okay? So I love math. I love things that make sense, and so I like to be able to plan a little bit more. So those are all things that I'm hoping for and kind of thinking that's kind of how it will go. So I don't expect that this is some kind of bubble. I think that, because these are real supply and demand factors, the only thing that doesn't fall into the real side is the Wall Street component, right? Anytime Wall Street moves big blocks of money, they can, just like when the government does a bunch of stimulus, they can artificially change and manipulate the market. And so, and that's just kind of makes me a little bit nervous. But as far as the normal supply and demand happening in the marketplace, that's all normal capitalism, and that's just kind of how it works. So anyway, so that's just kind of my take. I could be wrong, and but we'll just have to see. So hindsight's 20/20, right? And so if you're going to reach out there and look and make plans, but as always, real estate's a long-term play. So if you think if your horizon is out there 15, 20 years, then as my old mentor Art used to say, you never lose money until you have to sell. Okay, so if your horizon is out there 15 or 20 years, then the market can kind of float up and down, and then you're out there, it just floats up and down underneath you. Okay, and then when it's time to sell, you choose and take advantage of an opportunity there. So that's my take. So thanks for joining us today at The Rocket Guy. Come check us out at therocketguy.com. Please feel free to like and subscribe and put on notifications and other things, kind of keep us at the top of your feed. And we'd love some comments. We would love some questions so that it'll help us kind of drive new episodes and things we want to chat about. And we'll go out there and look and do some research and come back with some good stuff because it's all about the education. And if you're informed and educated, you can make better decisions, and that's what it's all about. So I hope you have a great day, and thanks for joining us. Come back and see us soon.